Hey there, it's J-Rod here for Rich Retirement TV, and today we're going to talk about one of my all-time favorite subjects, small cap stocks. They're pretty much the only type of stock that I trade, and I'm going to tell you today why they are the top trade for 2021. And we're going to do that. I'm going to show you 6 charts in 6 minutes that illustrate this point. And hopefully by the end, you love small caps as much as I do. But more importantly, you are set up for success for the rest of this year. So without further ado, let's get into the charts. All right, first chart. Why do I love small caps so much? Well, because they smoke large cap stocks. Large cap stocks like your Apples, Facebook, Google's, companies with 500 billion in market value, or trillion, 2 trillion in some cases. They get the lion's share of attention in the financial media, but they do not provide the lion's share of returns for investors. As you can see here on this chart, which is a 20-year chart of the Russell 2000 Small Cap Benchmark Index versus the S&P 500, there's massive outperformance here, and it's not even close. And just as a reminder, small cap stocks are those that have market capitalizations of $2 billion or less. But in these stocks, you have a lot of great stories that are either not being told or, again, because attention goes to large cap stocks, these small stocks are where the big explosions happen. You take a look at any given day in the stock market. The major outperformers are typically not the big stocks; they're the small ones. But you will rarely hear that story. So, myth debunked number 1: small cap stocks versus large cap stocks. You take a look, just the last 20 years, 377% return versus 214%. Not even close. And in a short-term period, small cap stocks offer you the best possible annual returns possible versus large caps. In the 1-year period, January 1 to December 31, the best return ever recorded for the Russell was 97% versus a mere 70% for the S&P 500. You take a look here at the other periods: 1 week, 1 month, 3 months, and 6 months. The Russell beats the S&P in every period, not even close. So just to piggyback on the last chart, over the long term, small caps are great. Over the short term, small caps are great. You need to say more? All right, so chart number 3, small caps after recession. This is where things get very, very exciting. In the 1-year period following a recession, which we just saw in 2020, the National Bureau of Economic Research designated June 8th, 2020 as the start of the recession. 1 year after that, small cap stocks post a 28% return versus a 16% return for large caps. And in addition, 90% of the time, going all the way back to the early 1950s, 9 times out of 10, small caps outperform large caps. And again, you take a look at some of these returns, not even close. In the 2009 recession, 26% for small caps versus 13. That's double. That's double the return. Take 1980. Again, look, 27% return versus 11% return. It's not even close. So, again, we've got 3 more months until we hit the 1-year anniversary of the recession declaration, but you got plenty of time here, and the outperformance isn't just limited to a 1-year period. We see that after, but the numbers here just in 1 year, beautiful numbers here. Small caps are where you want to be coming out of a recession, coming out of a bear market. All right, next chart. You got fears? A lot of people do, particularly analysts. There's not a day that goes by I don't hear about somebody talking about inflation rising, having an effect on stocks. They could not. All I know is that people have been calling for higher inflation for the better part of 15 years. And thanks to technology, we just haven't seen that happen. Globalization. I mean, there's other factors involved. I'm not an economist, so I'm not going to bore you with those details. But here's what I do know. As a trader, small caps, they're not afraid of inflation. They do very, very well. You take a look here at this chart. Again, the late 1970s, early 1980s, where you had the last period of like real hyperinflation, small caps soared. As you can see, the arrow that points up, that is a period where small caps outperform. And when the arrow points down, you see that's when large caps outperform small caps. And again, you got the outperformance here in the 1990s, where we saw real economic boom in inflation. Still, small caps outperform. The early 2000s, still another period where you had inflation. Small caps outperform. And so the last period of real underperformance for small caps, it was in the late 2010s, 2015 to 2020. We'll see that on another chart, but we just see we're seeing inflation expectations rise. We can expect to see small caps rise alongside them. All right, next chart. Worried about interest rates rising? It's another kind of headline thing. The Fed may have to raise interest rates sooner than expected because of runaway inflation. I don't see that being the case, but let's say, for the sake of argument, that you are a person that thinks that. Well, small caps are still your friend. This chart shows you the change, the average 12-month change in small caps versus large caps when the 10-year Treasury is rising. And again, we've got rising long rates. Russell 2000 beats the S&P. Same deal. You're looking at 10-year Treasuries versus 3-month Treasuries. Still see outperformance here. So as interest rates rise, you still want to be looking at small caps over large caps. Last chart. Small caps break out. If you watch my videos, you know I'm very serious about breakouts. I love breakouts. I love small caps. And you get both together, whoo! Now we're cooking with gas. So take a look at this chart. Boom. We were looking at the IWM. That's the ETF that tracks the Russell 2000. And this chart goes back to roughly 2004. And this the indicator you see here at the bottom of the screen, that is the ratio of the Russell 2000 versus the S&P 500. And put very simply, it just measures you take the price of the Russell 2000 divided by the S&P 500. That gives you the ratio here. And you see that anything above the zero line is outperformance. Anything below the zero line is underperformance against the S&P. And we see a downtrend start to form in outperformance. That's not saying they're underperforming, but there's a downtrend in place, and you see that persist until the 2015 to 2020. We have a period of small caps underperforming large caps in a big way. But you see here, I got them highlighted in red. Breakout, not just for the ETF here, which that's a beautiful breakout there up top, but in the actual performance against the S&P 500. We have a big breakout here in 2021, breaking that downtrend. And we are about to see a period of outperformance full-blown over the S&P. So not only do we have a beautiful breakout, it's supported. You're basically coming into, if you take advantage of this opportunity in small caps, you're coming into a period where small caps are breaking out to the upside and in a good position relative to large caps, which have run up a ton. You're seeing Facebook, Apple, Google kind of sell off, but small caps are still moving higher. I think this can continue well into 2021, 2022, even into 23. Again, you got a triple play basically. Breakout of outperformance. You've got small caps rising alongside inflation expectations. And let's say, for instance, the Federal Reserve does have to raise interest rates. Small caps still outperform. So you got a lot to love here in small caps right now. And if you like what you see here, stay tuned. I'm going to be highlighting some great small cap opportunities in charts here over the next couple of weeks. You don't want to miss them. But yeah, do yourself a favor. Take a look at small caps. Forget about large caps for a while. These are going to be your key to a very successful 2021 from here on out. Thanks so much for watching today's video. For Rich Retirement TV, I'm J Rod. We'll see you next time.